Jay Powell will make a speech on Friday. Many are very anxious. I doubt if the topics are going to be the same as previous years. It certainly seems, though, one of the key issues will be the portfolio, the current securities portfolio, and any changes that may be made. What do you see?
Well, I think you're exactly right. And remember, we're still in a period of removing accommodation. So that means that the balance sheet is going to shrink. That means that they're going to be allowing runoff and that there'll be a certain amount of sales. And what that means is that the portfolio will change, but that I think it'll be in a predictable way, much as they have described over the last several months.
Now, one of the issues that seems to make sense to study is proportionally issuance, which is a huge topic as it grows rather large, and the national debt's top 21 trillion. There's a lot more short-term securities. Does that make a difference to Jay Powell and company?
It does in the sense that it really affects, I think the market movement in those issues affects the interest rates. But I don't think it will affect the direction that the Fed will go, because they're still primarily allowing the runoff of the short-term securities, and in the longer securities, they're making isolated sales. But they'll still be watching that, because the market movement will affect how they move with those sales.
I got you. Now, another issue, and I think that this one isn't as important as the rest, but it still merits some introspection. That is the mortgage securities versus the Treasury securities. The Fed seems reluctant to let go of the mortgage securities. Most likely, they'll let them run off without any liquidation. Would you agree with that?
Yeah, I think that that's probably the right thing. I don't think you want to flood the market with the mortgage securities to any extent. I think you want to manage that fairly carefully, because that market will affect the interest rates on those kinds of instruments, and that'll be important to the housing market. So I think that that's an important consideration.
Now, when it comes to interest rates, it seems rather counterintuitive if you've watched the last couple of weeks of trade. They are really dropping rather dramatically. We're 20 basis points off our high yield closing 10s. Do you see any major driver for that? Your final thought?
Yes, I do. I absolutely see a driver for that, because I think the markets have come to the conclusion that the Fed is serious about fighting inflation. And so the inflationary pressure at the long end of the market has adjusted to that fact. And I think that that's the key driver in why the 10-year T, for example, has stayed low.